is buying investment real estate a good idea with today's prices? Okay, so here we're in the lower mainland, and a lot of people have been making a lot of money in real estate just by buying something and waiting, or buying a pre-construction and all of a sudden it's gone up over here. But of course, the prices are too high now, Christian. There's no way this is a good idea. The houses are too high now. A good advisor can help you to say, is this a good investment over here? Because you got to remember, if you don't invest it in real estate, you got to invest in something else. So they can compare against stocks, they compare against other areas. So is this a good idea? So the quick answer is it depends. It depends on what you are getting over here. So here is real estate as an investment class, even a good idea. Think about the ROI, the return on investment. So we know the stock market returns are 6%, 8%, things of that sort. But if we think, well, what's the ROI on real estate? And is this a good investment? Okay. Let's say there's a $50,000, which is a 20% down on a $250,000 condo. So what you want to do is you want to do an analysis on this. And if you can't do it on your own, then you want to get somebody involved who knows. So I'm going to make some assumptions here. $50,000 on a $250,000 place, cash flow break even year one. So basically, we always like a cash flowing or a break even as soon as we buy it over here. But now we can also figure out, well, real estate is such a great investment because rent goes up over time, and rent goes up and mortgage goes down. So over time, if you're break even in year one, in year 10, you should be cash flowing. So I'm going to make an assumption over here. You're $300 a month positive cash flow by year 10, $1,000 a month positive cash flow year 20, $3,000 per month positive cash flow year 30. And by year 30, of course, this place should be already paid off. How do we calculate the ROI? So formula is not that simple, but I've calculated one. So here, I'm going to make a couple assumptions. Now, capitalization rate is about 4.3. And the growth rate of the real estate is at about 5%. The future value in year 5 of that $250,000 property should be about 319. That's me growing it at 5% annually. But the future value in year 30 is 1.1 million. That's by me growing it at 5% annually. What is the ROI as an investment compared directly to a piece of the stock market on my 50 grand, not on the 250, on the 50? We're looking at 23.4% annual return. I've taken account the cash flow, and I've taken into account over here the capital appreciation, and I've taken into account the fact that there's no mortgage after 30 years, and this is the equity value of my asset over here. So of course, you know that I'm a big real estate investor. I'm a financial advisor that helps to integrate real estate with your RSPs, TFSAs, and things of that sort, and figure out, is this a good investment or not? But now I know the first thing people are thinking of is $50,000 on a 250 on a break even. We can't find that here in the lower mainland. And the quick answer is you're correct. You probably can't. And that's why you want to pair up with an advisor who can help this. Maybe you've got a realtor on your team that could help you to find this. But I already know that me and my team are able to find this. Why? We have several times over. There was a property under $200,000 that generated $1,200 a month in $1,200 a month in rent that we helped the client put in place just last month. This was not in the lower mainland, though. That's the issue. This was not in the lower mainland. So we actually help clients look outside of the lower mainland if they're thinking of investing in real estate. So is Vancouver the absolute right place? Maybe, maybe not. We'll have pros and cons. The capital appreciation outside of the lower mainland will be lower, but the cash flow will be better. So are we staying away from the lower mainland? Also, no. Last month, we were able to find a place that was $390,000 inside the lower mainland, but it was generating a rent of $2,200. So what we're going to do is we're going to compare the cap rates. Now, if you could do this on your own, fantastic. You don't need anyone. But if this is something that you're interested in, but you cannot find this on your own, or you can't calculate the ROIs to see if this is a better investment than your RSPs, your TFSAs, you should be involving an advisor. That's the whole point. You should be involving an advisor over here. So here I show you a case study of a young couple, that the types of problems that we can solve. So let's say they're getting married and they both own condos. Let's say they want to start a family. They also want to upgrade their home at some point, but they also want to invest for retirement. They realize, two smart professionals, but they would like some help. They would like some help. So what are some options that they've been toying around? Well, they said, well, one, we could sell both condos and then we can upgrade to a larger home. That's one thing they could do. They could also keep one as a rental, sell the other one for the down payment. Then the question is, well, which is the better one for us to sell? Another option is they could sell one, use that, and reinvest the second one somewhere else in a piece of real estate. So they actually now still own their home, but now they have this investment vehicle. This is a perfect example with two professionals, even though they're well educated, but they don't have the expertise to solve this question over here. So then you might say, well, which of these three options is going to yield them the greatest amount come their retirement over here? That is a very, very, very sophisticated question, which the average person cannot solve on their own. But an advisor, the correct advisor, can. And we can basically show what this would look like, assets, liabilities in the future, to help these people to guide a decision over here. And if they said, well, let's say they picked option 3 and they said, well, we've decided to do option 3 because your analysis, Christian, shows we're going to be better off getting this new property over here, but now they need help in actually finding the property. So then we could do an analysis, say, where is this other property over here? And we could do analysis on other areas such as the Fraser Valley. We could do analysis, case study analysis, and saying, well, what is the ROI that I'm projected to get if I was to get, let's say, here locally in the Lower Mainland, Vancouver or Abbotsford, or let's say if I was to go out of province. If I go out of province, Christian and his team can help to figure out, different areas in different provinces to see, well, what's the cap appreciation, what's the cap rate, what's the ROIs, and which is, to help to guide you to make that best decision over here. So here we do another analysis called a Monte Carlo analysis. And the Monte Carlo analysis helps us as well in order to figure out, what is the probability of success. So the beautiful thing about a Monte Carlo, which I don't think a lot of people have the expertise in doing, is this over here can actually break things into a probability. If I was to upgrade my home by selling the 2 condos and then just buying a larger home and no investment properties, I could basically show with great accuracy you have a 75% chance that this will be the value of your assets come retirement. So let's go to option 2. What if I did this, what if I did this other option? Then we have a 75% chance or an 80% chance that this will be the value of your assets. So we won't know 100%, but a Monte Carlo could help us to make a decision. Well, what if I just buy this real estate property? Then it'll show, but by having all of these probabilities, maybe some people have they took a stats class and understand how the probabilities work. They can understand, wow, like we're talking a difference of $2 million with an 85% probability, then absolutely I should be doing option, let's say 3. Now, isn't that where your advisor should be doing? Which most advisors don't, because of course they concentrate too much just on, your RSPs and your TFSAs. So here at Latitude West, our philosophy has always been, how do you accumulate and grow wealth over here? And we use models from the richest investors in the world. And the richest investors in the world are having money in the stock market in the form of mutual funds or non-registered accounts, TFSAs, but also real estate as an investment class. And we're not talking about personal real estate, your home. We're talking about, we're talking about real estate that you would invest in and then hold. And so how can you get guidance in helping that? And why are so many people doing so well by doing this? Well, maybe you need some professional help if this is something that you're interested in. So professional, higher end investors usually do stocks, they'll do real estate, and they'll do a form of reserve. Okay. So here, if you're familiar with the Tiger 21, they're the wealthiest investors in the world. And if you take a look at their portfolio, it's not all in the stock market. 31% is in real estate assets, which they own. And then they have another 22% in a form of a reserve. Now, why is a reserve so important, and why do we believe a reserve is so important? Is because you want to be able to capitalize on an opportunity when it comes. Might be in stocks, might be in real estate, might be somewhere else. But if you don't have the availability, a lot of people make the most money in the stock market when, of course, it crashes. But if all your money is in stocks, then your money has crashed. You can't take advantage of the opportunity. You have to wait for it to recover. Um, and sometimes the opportunity is in real estate. There were some great opportunities in '08 when, all this real estate went down in different parts of Canada and the US. But if you didn't have any cash, how could you capitalize on it? So what I advise over here is to think, well, if I want to be very, very wealthy in my future, well, shouldn't we be modeling the wealthiest investors in the world? And that's why our philosophy kind of matches the Tiger 21 philosophy. And remember, these are investors that need $10 million minimum to be part of this group. And the average investor has $100 million over here.
Hi, I hope you got some great information. Did you know that if you were to set up a time to meet with us, our session is completely complimentary? We'd love to give you some more advice. You have more to gain than you think. Feel free to connect with us, and we'd be happy to chat.